Hey traders, welcome back to another video. Today we're going to be taking a look at TradingView.com and how you can use this free source to study correlations in the market. It's a really cool and nifty way to study financial markets and to look for excellent trading opportunities. So in this tutorial, I'll be showing you how you can use TradingView and how you could potentially take advantage of some strategies and setups in the financial markets, whether you're trading foreign exchange, indices, commodities, or perhaps stocks. Let's take a look. Welcome back to my channel, guys. Today we are talking all about correlations, and I do want to take half a second here to remind you, if you're new to my channel, consider subscribing down below. By clicking that subscribe button, number one, you'll be helping out my channel, but number two, you'll also let YouTube know that you want more trading content to come your way for free. Anyways, today we are taking a look at the NASDAQ in front of us, and I want to talk correlations, but before we do, what is a correlation? A correlation is essentially, and this is just sort of bro logic here, I'm just giving you off the top of my head.
Low key, bro.
Correlations are the study of whether or not a significant move in one market causes a similar or inverse move in another. So for example, let's say we're taking a look at the NASDAQ here. Does the dollar making a move up, like a strong dollar, does that cause the NASDAQ to also move up? Or does it cause the NASDAQ to move lower, which that would be called a inverse correlation. Correlation studies are fascinating in markets because it is essentially studying the impact one market has on another. And this is going to make a lot more sense as we get into some free indicators that you can use on TradingView. So let's start with the compare function. If you take a look here in the top left, next to this search symbol where you have here, you can select which symbol you're looking at, you have the compare or add symbol. If I click on this, I'm currently looking at the NASDAQ, remember, but you can see that there's an option to select or compare another symbol. So if we take a look at this, we're hovering over DXY. This is the US dollar currency index. Now, feel free to search whatever you'd like when you're playing around with this on your own. But for example, let's take a look at the dollar and we'll cross it against the NASDAQ to see if there's any significant moves there. Now, when you hover over this, you'll see that you have a couple different options. You can trade, or you can select the same percentage scale, you can select the new price scale, or you can do a new pane entirely. And I'll show you what each of these options does. So if I do same percentage scale, you can see that a orange line just popped up on the screen. Now, of course, you can adjust this orange line to be whatever you'd like. Let's say, for example, we want it to be this turquoise color. Okay, so this is the dollar in turquoise, and we of course have candlesticks showing the NASDAQ. But let's actually make the candlesticks just a line to keep things very simple. So now what we have is in the top left again, if we take a look, we have the NASDAQ and we have the dollar index. And these are now laid on the same chart for us to study if perhaps there is some impact on the dollar, what that could perhaps do to the NASDAQ. And what you can see here is that a decrease in the dollar is right here in this example, followed by a NASDAQ increase. Okay, well, we could take a look at go back in time and see if there's any impact here. Here's a period of time where the dollar was down and the NASDAQ was up. Here's a period of time where they were both kind of flat. And let's see if we can find maybe a dollar up, NASDAQ down example. Again, we're looking at this. So here's an example where dollar's making a move up. The NASDAQ was seeing some decline during that same period of time. And to make things a bit confusing, you can see that it's not quite perfect. Sometimes you have both moving in the same direction. So what does this tell us, and how the heck does this make a trading opportunity present? Well, it's an observation that we can start with, but I actually don't prefer to use the compare function. It's the simplest way to study a correlation, but it's a little bit granular and it doesn't give us a hard nominal value for this correlation. So what can we use instead? Well, let's actually take off the DXY line chart and let's just take a look at the indicators list. Now, I have this as a favorite. Now, under favorites, of course, on TradingView, you can select anything you like. Whenever you're looking at an indicator, simply star it and it will save to your indicators favorite list. What we're going to do now is I'm actually going to apply the correlation coefficient. And you can see as soon as I open this up, it now asks me to confirm inputs for what I'd like to study. Remember, I'm still on the NASDAQ chart. So let's go ahead and edit this, and we're going to select again DXY. We're going to select the index, TVC DXY, apply this, and there we go. Let's switch to a daily chart, and what you can see here is now we have a pane in the bottom of the screen. Now this is a new pane, P-A-N-E, no physical pain, don't worry. What we're looking at here is, of course, the correlation coefficient, and this is actually giving us a line from, or a indicator from 1 to -1. Now what does this mean? A strong reading or positive correlation will print close to 1. Now what this means is that if the first and second asset both move in the same direction, typically, that has a strong positive correlation. If something has a strong -1 reading or close to it, it generally means that they are moving inversely to one another. So of course, I reiterated that positive correlation, negative correlation, okay? And so now again, going back to our example of NASDAQ versus the dollar, we've now crossed them on this chart down here. What we can see here is that there generally is, not always, but there generally is more of a negative correlation. Okay, so what that means is that typically when the NASDAQ moves up, the dollar moves down. When the NASDAQ moves down, the dollar is moving up. So they have some sort of inverse relationship to one another. Now, correlations are cool because there's so many of them that we could study. I'm going to show you another one. Let's take a look at KO. This is one that I always like to study for simplicity. We have Coca-Cola pulled up, but let's now change this down here. Instead of DXY, we're going to change this to Coca-Cola's #1 competitor, Pepsi. PEP is the symbol. Now we're looking at a stock example. And what I want you guys to notice is look at this. What you can actually see is there's a strong positive correlation between these two companies, which would make sense, right? Generally speaking, if people are buying lots of sodas from Coca-Cola, they're probably out there buying a lot of sodas from Pepsi, right? So this concept here is studying the positive correlation. Now in a second, I'm going to show you how understanding this correlation concept can actually generate excellent trading opportunities. But before I do, again, I would just want to reiterate that we're on the same page. Remember that a strong positive number means there is a positive correlation, and a strong negative means there's a negative correlation. I personally prefer to use this indicator, but feel free to remember you can always use the compare to function. So in this case, let's go back to this for a second, and I'm going to do PepsiCo, but this time I'm going to do a new pane. Now, the reason I'm doing a new pane here, let's remove this for a moment, and we can actually now just take a look at these two things side by side. So honestly, sometimes using either one can be useful. The correlation coefficient can be useful, but so can just crossing the charts, especially when we start talking about trading opportunities perhaps presented by these scenarios. All right, so now we're going to take a look at a strategy that you can actually use the concept of correlation to potentially trade. So I've added all three of our concepts, but now we are of our windows here, indicators, but now we are actually going to be using the euro dollar and the pound dollar. So this is an example for currency traders out there. What we can see is that we've crossed the euro and the pound, and what we can see at the bottom in this third section here is that there, generally speaking, is a pretty strong positive correlation between the euro and the pound. Okay? So we can see the pound is here, the euro is here. We typically see these things moving in the same direction. Now, what the strategy that we are going to be looking for involves is using two positively correlated assets, okay? And we are going to be looking for rare instances in which that positive correlation, quote unquote, breaks down. How do we spot breakdowns in the correlation? Well, use this indicator here. These are periods in which the euro and the pound are not moving in the same direction. In fact, they are moving opposite to one another. These are going to generate potential trading opportunities for people who are looking at these currency pairs. Now, what is the strategy? Well, first of all, let's mark quickly all of these different events. I'm going to just quickly go through here and add red lines to where they occur. Okay, so I've got all of my red lines added, and what you can see here is I've just marked instances on the chart where the pound and the pound dollar and the euro dollar have moved opposite to one another. Okay, so for example, this is an event where the euro is moving down and the pound is moving up. This is an event where the euro is moving down again, the pound is moving. I'm sorry, actually, this one is less thorough, but you can see it's slightly moving sideways, and this one is slightly moving up. And then, of course, this one we have kind of a move down and a move up. So what we're going to be looking for in these examples is essentially we're going to be taking two trades, one on each one of these currency pairs, trading it back to correlation. Now, there are some risks here, and we'll talk about that as we get started here, but the concept would be this is a no stop loss trading strategy, which is, again, something that some traders really don't like, but in some cases you are very, very hedged, but it's not perfect. So I'll get to the cons in a moment. What we're going to be doing here is essentially we're going to be buying the currency pair that has gone down, and we're going to be shorting the currency pair that has gone up. And we're going to be trading this breakdown of correlation back into correlation. So the example would be, in this first case, the pound is moving up, the euro is moving down. So we would buy the euro and we would short the pound. Now, remember, these typically are going to move back into correlation, meaning they're probably going to move the same direction. That is exactly what we saw happen as the pound started moving up, and at the very same time, the euro started making a strong move up. So in this trade example, one trade is profitable by a pretty good amount, and the other trade is slightly negative. In this case, you would have actually made money by trading it back to correlation. Now, at what point do you close the trade? This is something that is kind of up to you as the trader. This is not something that is a strict rule by any means, but perhaps you want to trade something like a 60 back into 60 or 65% correlation. So let's say 65 correlation comes in right around here. So at that point, we take profits on the euro win, and we would cover our loss. Actually, it's probably about break even on the pound. So we've made a little money on the euro, and let's say we're just about break even on the pound. Let's try that again. Let's do the next example here. Let's actually zoom in just a bit so we can see this a little bit better. And let's say at this point, we have the pound making a move up and the euro is slightly flat. At this point, we get another instance in which volatility has caused the correlation to actually break down between the two currency pairs. So what do? We short the one that's made a move up. So in this case, we are shorting the pound. And at the very same time, we would buy the euro to trade this correlation back into existence. We were expecting these two things to move in the same direction. Does that happen? Yes, it does. They both decline pretty significantly. At what point do we close out for a profit? Well, remember we did our 60% correlation. So in this case, let's take a look at how that would have worked. So remember we said that we would go long on the euro. So we'd probably lose a little bit of money. Let's call it right around there on this trade. And at the same time, on the short, trading it back to, let's call it around there, we would make just a slight amount of money. So this might be one that doesn't make very much at all. But what you'll notice is that if you do this often enough, a lot of times there is going to be a nice slight profit. Now, again, it's not a miracle strategy by any means. One trade is probably going to be profitable and the other is probably going to be a loser. But in this case, here's another example. In this case, the euro is making a move down, and the pound is making a move up. So remember, we would be buying the euro and shorting the pound. Now, again, the concept here that is up for criticism is, of course, that one is most of the time when this correlation comes back into play, The idea is that there's a bit of a catch up, meaning that one of them is going to come back more than the other. So the euro makes a move higher, so does the pound. And again, you might need to adjust sizing for this because again, the pound is a bit more volatile than the euro, moves more on an average true range basis. So you might need to play around with it. The point here, guys, is that this concept, generally speaking, can be traded. This concept of correlation, and now I've showed you how to study them. Even if you don't trade correlations as a strategy, it can be very useful just to understand how correlations work in the markets. Thank you guys for watching and have a great day. If you're looking to improve as a trader, we've got some cool free resources here that I wanted to share as we close today's video. Down below in the description, there is a link to join our Discord channel or our Telegram channel. And we also have our website, a1trading.com, where traders can get access to free course material to help you improve as a trader. Remember, we are also live Monday through Friday on this channel around 9:30 a.m. US Eastern, broadcasting most live news events and that sort of thing. So hope to see you there. And also, we do have a couple videos here showing up on the screen. If either of these seems like it might be helpful to you, then make sure to click here or here, and we'll see you there.